Welcome to the Deep Dive, the show that's basically your shortcut to being genuinely well-informed. Ever feel like you're just wading through financial jargon? Terms like risk management get thrown around all the time, and it's easy to just sort of nod along. Well, today we're cutting through that fog. We're doing a deep dive into enterprise risk management, or ERM, and our guide is the incredibly comprehensive book by Paul Sweeting, Financial Enterprise Risk Management.
That's right. And look, our goal for you today isn't to, drown you in every single technical detail. No, we're here to pull out the really important stuff, give you a clear, sort of concise understanding of how these big organizations grapple with risk, in a holistic, ongoing way. Get ready for some surprising bits and hopefully a few aha moments. We want to demystify how these major players try to stay resilient and, well, sometimes why they don't quite manage it.
Okay, let's unpack this then. When we talk about risk in finance, what exactly are we getting at? Is it just like the chance of something bad happening, a bad investment maybe, or a market crash?
It's a bit more nuanced than just, bad luck. In finance, risk really has two key parts. First, yeah, it is the probability of something specific happening, but just as important is the severity of the loss, if that loss actually occurs.
Okay.
Think about buildings insurance. The probability of your house burning down might be quite low, thankfully, but the severity, if it does, it's huge, right? The cost to clear the site, rebuild everything. Now compare that to something more common, like a roof tile blowing off in a storm. Much higher probability maybe, but the severity is way lower, just repairing a bit of the roof.
Right.
So when you multiply that probability by the potential severity, you get a much clearer idea of the expected loss. So it's not just if something happens, but really, how bad could it actually be?
That distinction really clicks. It shifts it from just, will it happen, to, okay, what if it really hits?
Yeah.
So if that's risk, what does this enterprise risk management, this ERM thing, add to the picture? That enterprise part sounds bigger.
Precisely. Yeah, it sounds bigger because it is bigger. ERM brings in this holistic, big picture view. It's about managing all the risks together across the whole organization, not just looking at them one by one in silos. And that includes the stuff you can easily put a number on, like market investments, but also the much harder stuff, like reputational damage from a scandal.
Okay, the intangible stuff too.
Exactly. And here's a really critical point. ERM isn't some report you do once and file away. It's an ongoing process. It starts with understanding the company's context, then finding all the risks, measuring them against the firm's risk appetite, deciding how to handle them, taking action, and then constantly reviewing and reporting. It's a loop, a perpetual cycle of vigilance, really.
Right, so it's like building a continuous radar system, not just, checking the weather forecast once a year. Understanding that foundation really helps you see beyond those simple headlines, doesn't it? You start to appreciate the structured thought behind keeping these big places running. Now, here's where I think it gets really interesting. Who are the actual people inside these organizations doing this intricate dance of risk management? And crucially, are they all pulling in the same direction, or are there like internal tensions?
Oh, it's definitely a complex web. And no, their interests absolutely do not always align. That's a huge part of the challenge. Right at the top, you've got the board of directors. Their role is absolutely crucial. They need to have enough knowledge, keep learning, get regular performance reviews themselves. And a key thing is the difference between executive directors, the ones running the show day to day, and the non-executive directors. Those non-execs are vital for independent oversight, keeping the executives accountable. And then within the board, you have specialized committees like the audit committee and the risk committee doing deep dives themselves.
You mentioned tensions, though. How does that actually play out? Because I can just imagine the people trying to make money versus the people trying to stop losses.
Yeah.
Must be some friction there.
Absolutely. Sweeting's book talks about two main models for how the business units and the central risk function interact. There's the offense and defense model. Pretty clear, right? The business units are the offense, trying to maximize returns, which usually means taking on more risk.
Right, pushing the envelope.
Exactly. And the central risk function, the CRF, is the defense, trying to minimize potential losses. So it's this natural tug of war. Then there's the partnership model. This tries to embed risk people directly into the business units to collaborate more closely.
That sounds better, maybe. More cooperative.
It sounds better, yeah, but it has its own risks. The danger is that the risk people embedded in the business units might become, too involved. They might lose their independence, their objective view, start identifying too much with the business unit's goals.
Ah, I see. So they might go native, so to speak. That's fascinating. It really is like a strategic balancing act. And presumably, the chief risk officer, the CRO, is right in the middle of all this.
Exactly. The chief risk officer, the CRO, is pivotal. They're ultimately responsible for setting the firm's risk management policy, the standards, establishing a common language for risk across the whole place. They're that crucial link between the risk function, the CRF, and the board, making sure the board knows what's going on and that the board's decisions get implemented. Plus, they have big external reporting duties to regulators, investors, rating agencies. It's a huge job.
Wow. Yeah. And beyond the board and the CRO, there are other key internal players, right? Like pricing teams.
Absolutely vital. Pricing teams are crucial for profitability and, frankly, solvency, especially when you're dealing with complex stuff. Think about those collateralized debt obligations, CDOs, from the financial crisis. Or certain insurance products, like with-profits policies.
Hmm.
Those can be really complex. Sometimes they involve smoothing returns over long periods, or even using money from new policyholders to help pay guarantees promised to older ones. Intergenerational subsidies, essentially.
Complex stuff.
Very. So the book stresses their reward structures really need to encourage long-term thinking, long-term profitability, not just hitting quarterly targets. Then you've got internal auditors. They focus more on financial risks, detecting fraud, making sure rules are followed, and of course, external auditors. They're technically working for the shareholders and beneficiaries, making sure the financial info is reliable. But there can be potential conflicts of interest there too. If the audit firm also provides other lucrative consulting services to the company, well, there might be pressure to sign off on the accounts, you know?
Yeah, you can see how that could get tricky. So understanding this part helps you see that risk management isn't just some department tucked away somewhere. It's this whole web of roles, responsibilities, and, yeah, sometimes competing interests that need really careful governance to work right.
That's it exactly. It's a system, and like any system, it needs constant attention.
Okay, risk isn't just about what happens inside the company walls, right? The whole world outside. That plays a massive, often unpredictable role. I'm always struck by how quickly external stuff can just change the game.
Oh, absolutely. The external environment is a huge driver of risk. Think politically, how much market freedom is there? How much government control? What's the regulatory approach? Even things like cultural attitudes towards wealth redistribution, taxes. That all impacts how firms operate. And public opinion, media sentiment that can shift the political mood really fast, leading to suddenly stricter rules or new laws.
Yeah, the political winds can change quickly.
And economically, obviously, you've got the business cycle, booms and busts, global capital flows. And in insurance, there's this thing called the underwriting cycle, basically. Capital floods into the market when insurance rates are high and profitable, driving rates down. Then capital flows out when rates are low, eventually pushing rates back up. It dictates the whole context for risk-taking.
Right, and it's not just the environment changing, but the institutions themselves are so varied, aren't they? They've evolved so much, each with its own specific set of risks.
Definitely. Just look at the diversity of financial institutions. You go from those early goldsmiths acting as bankers to modern high street banks, limited liability companies, shareholders, depositors, bondholders, and mutual banks like building societies in the UK. Then you have investment banks. Their original job was raising funds, but now they do M&A, trading, repackaging risks. Think about those CDOs again.
Yeah, they got complicated fast.
And insurance companies, too. Non-life insurers covering ships, planes, cars, houses, and those really tricky long-tail liabilities like claims for asbestos exposure, which can take decades to emerge. That nearly broke Lloyd's of London, remember? Versus life insurers selling investment policies, unit-linked funds, and those complex with-profits policies we mentioned with smooth returns and guarantees. And then pension schemes. Defined benefit, defined contribution. Plus, the complexity added by things like the Pension Benefit Guaranty Corporation in the U.S., the PBGC, which insures private pensions.
It's a whole ecosystem.
Yeah.
Which I guess raises the question, with all these different players and pressures, how do conflicts of interest between their stakeholders play out? Because it sounds like everyone wants something slightly different.
They often do. These stakeholder conflicts are a constant dynamic. Take shareholders. They generally want the company to take risks to maximize returns, right?
Yeah.
Higher potential profits. But debt holders, the people the company owes money to, they prioritize security. They want the company to minimize risk to make sure they get paid back. So direct conflict there.
Classic tension.
Yeah. And in pensions, you often see scheme sponsors the company's backing the pension plan. They might actually prefer riskier investment strategies, maybe for tax reasons or to reduce their cash contributions. But that can conflict with the interests of the trustees and the members who just want the scheme to be well-funded and secure so their pensions get paid. And even the trustees. Sometimes their own compensation might be linked to the sponsoring firm, potentially influencing their decisions, not always purely focused on the member's best interests.
Right. So it becomes clear that this whole financial world is incredibly interconnected. It's constantly shaped by external factors, the specific nature of each institution, and these internal tugs of war between stakeholders. Puts resilient in a whole new light.
Okay, so what does this all mean for actually quantifying risk? How do the experts go from these big ideas, these qualitative factors, to actually measuring and modeling what might happen? It seems hard. It is hard. It's a massive challenge, and it needs a pretty sophisticated analytical toolkit. We usually start by categorizing risks. There's liquidity risk. It's basically two things.
Yeah.
Can the firm raise money when it needs it? That's funding liquidity. And can it buy or sell assets easily without tanking the price? That's market liquidity. Interestingly, sometimes being illiquid can actually be desirable if you get paid a premium for holding something that's hard to sell quickly.
Okay, that's counterintuitive.
A little, yeah. Then there's the big one, systemic risk, often called contagion risk. This is where the failure of one firm or one market starts spreading like a virus to others, potentially destabilizing the whole system. It can happen through failures in the financial plumbing, like payment systems, or because lots of firms hold the same assets, so if they all try to sell at once, a crash. Or if everyone is exposed to the same big counterparty that failed.
Like dominoes falling.
Exactly like dominoes. We also deal with demographic risks, particularly relevant for insurance and pensions. Things like mortality risk, people dying earlier than expected, and longevity risk, people living longer than expected. Within that, you worry about level risk. Maybe your basic assumption about death rates is just wrong. Volatility risk, just random fluctuations because you only have a finite number of people. And catastrophe risk, like a pandemic causing a spike in deaths. And a key concept in insurance here is adverse selection, the idea that the people who think they're most likely to need insurance are the ones most likely to buy it, which skews the pool for the insurer.
Right. You sure end up with all the bad risks.
Potentially, yeah. And finally, there's a huge bucket called operational risks. This covers failures in technology, processes, people, mistakes, fraud, external events like fires or floods. Within that, you have things like data risk, incorrect data entry, duplicate records, misreporting, and hugely important, reputational risk, which often isn't a risk in itself, but a consequence of other failures, operational, ethical, whatever, leading to a massive loss of public confidence.
Wow, that is a broad landscape of risks. So what are some of the tools for just identifying all these different things, spotting them in the first place?
Well, for identification, people use frameworks like PESTELI analysis. That stands for political, economic, social, technological, environmental, legal, and industry risks. Just a structured way to brainstorm. Firms also use prompt lists, checklists, basically, and maintain really comprehensive risk registers, trying to capture everything they can think of.
Okay, so you identify them, then you need to measure them, right? Even the abstract ones. We're getting into statistics now, but let's assume our listeners are savvy. What are the key statistical ideas we need to grasp for financial risk?
Absolutely. Beyond just averages or how spread out things are, the shape of the possible outcomes is crucial. That's where skewness comes in, tells you if the distribution is lopsided, leaning one way or the other. And even more importantly, kurtosis. Think of kurtosis as measuring the fatness of the tails of the distribution.
Fat tails, meaning?
Meaning the likelihood of really extreme events way out from the average. Compared to a nice standard bell curve, financial markets often have fat tails. Those tails represent the rare but devastating market crashes or the sudden huge spikes that a simple, normal model might completely miss or underestimate. That's critical. And for relationships between different risks, yes, correlation is important, but we need to understand how risks might behave together when things go really, really wrong.
Okay, that's a huge point. It's not just about the average day, it's preparing for those extreme fat tail events that the standard models might ignore. So what advanced tools do they use to capture these complexities, especially when, as you say, different risks might all blow up at the same time?
Right. This is where it gets more sophisticated. For instance, instead of relying solely on the normal distribution, which, as we said, often underestimates extreme events, experts might use something like a T-distribution. It looks similar but has inherently fatter tails, so it better reflects the potential for big shocks we see in real markets. But to model several things happening at once, how different risks interact, especially in the extremes, we use multivariate distributions and copulus.
Copulus, okay, that sounds advanced.
It is, but the key idea is they let you model the dependence between different risks, especially in the tails. This concept of tail dependence is vital. It asks, if one risk blows up, How likely is it that another risk also blows up at the same time? And here's a critical insight from Sweeting's book. A standard multivariate normal distribution, which is used a lot. Well, it actually lacks tail dependence.
Wait, really? So it assumes extreme events happen independently?
Essentially, yes. It fails to capture how different risks can all spike together during a crisis, which, as you can imagine, is a massive flaw if you're trying to model systemic risk or portfolio meltdowns.
Wow, that's a huge takeaway. So the analytical tools aren't just about numbers. They're about choosing tools that actually see the potential for those rare extreme events, especially when they gang up.
Precisely. Choosing the right tool for the job is paramount.
Okay, so once all this complex identification and measurement is done,
Mm-hmm.
what then? What are the actual strategies? How do organizations deal with these risks? Do they just avoid them? Or sometimes can they even exploit them?
Good question. That brings us to risk responses. Generally, actions fall into categories like risk reduction, which itself includes avoidance, control, transferring the risk, like buying insurance, retaining it, meaning just accepting it, or yes, sometimes calculated exploitation.
Exploitation, how does that work?
Well, sometimes taking on a specific risk might be core to the business model or offer a significant potential reward that justifies it, assuming it's understood and managed. But guiding all these responses are key principles. They need to be cost-effective. You don't spend more preventing a risk than the risk itself would cost. They should aim for simplicity where possible. They need to involve actual action, not just gathering more information.
Right.
And they need to be flexible, adaptable.
Makes sense. And how do they decide just how much risk is acceptable to take on in the first place? Because it's always a trade-off, isn't it? Opportunity versus danger.
It absolutely is, and that's defined by the organization's risk appetite. This is often expressed formally, sometimes even mathematically, using utility functions, reflecting how much risk they're willing to take for a certain level of expected return. To assess where they stand relative to that appetite, firms use various risk measures. Value at risk, VAR, is probably the most famous one. You hear it a lot.
Yeah. VAR, what is it exactly in simple terms?
It basically tries to estimate the maximum loss you'd expect over a certain time period at a certain confidence level. Like, we're 99% confident we won't lose more than $10 million tomorrow. But, and this is a big, but VAR has major limitations, as Sweeting points out forcefully. We already talked about fat tails and skewed outcomes. VAR doesn't handle those well. It's often based on normal distributions. It's also generally insensitive to that crucial tail dependence we discussed, so it can seriously underestimate what happens in a real crisis when everything goes wrong together. And it can be really misleading during liquidity shocks when you suddenly can't sell assets at the prices the model assumed.
So widely used, but potentially dangerous if you rely on it too heavily.
Very much so. A more robust measure, the book argues, is tail VAR, also called expected shortfall. Instead of just saying, what's the maximum loss at this point, tail VAR asks, okay, if we breach that point, what's the average loss we can expect in that really bad tail? It gives you a better sense of the severity beyond the VAR threshold, and it tends to aggregate better across different business lines. For those unquantifiable risks, like reputation, firms often use risk maps just plotting likelihood versus impact visually.
Okay, so TailVAR gives a better picture of the downside when things go really bad. That seems important. So connecting this to the big picture, it sounds like even popular tools like VAR have serious blind spots. How do firms then try to optimize this whole risk-return thing, especially when deciding where to put their capital?
Right, they need tools for optimization. A classic approach is mean variance optimization, often used in portfolio management. It tries to find the efficient frontier, the set of portfolios offering the highest possible expected return for any given level of risk, usually measured by standard deviation or variance. But it has practical problems too. It typically relies on that normal distribution assumption we critiqued. It can sometimes suggest really unrealistic portfolios, like putting huge amounts in one obscure asset class. And the results can be very sensitive to small changes in the input assumptions.
Sounds like it needs careful handling.
It does. There are ways to mitigate that, like techniques called resampling.
Mhm.
Firms also use the concept of economic capital. This is about figuring out how much capital the firm needs to hold specifically to absorb unexpected losses from the risks it takes. This helps them price new products properly, ensuring the price reflects the risks, and it helps allocate capital across different business lines, directing more capital to areas that generate better risk-adjusted returns. This leads to performance measures like ROACE, risk-adjusted return on capital, and SVA, shareholder value added, trying to make sure deploying capital actually creates value, considering the risks involved.
Okay, so it's clear managing risk isn't about eliminating it. It's about making deliberate, strategic choices, understanding the trade-offs, and constantly questioning the tools you're using, knowing they might have hidden flaws.
That's a perfect summary. It's about informed decision-making under uncertainty.
But sometimes, even with all the models, all the frameworks, things go spectacularly wrong. Financial history is, well, littered with failures. It reminds us there's always a human factor, right, and an unpredictable element. What can we, as learners, really take away from these real-world breakdowns?
Oh, the case studies are incredibly powerful. They show where the theory hits the messy reality, and often it's the human and organizational factors that fail. Let's start with a big one, the 2007-2011 global financial crisis. We saw how securitization, packaging up loans like mortgages into securities, MBSs, CMOs, fundamentally changed risk. It turned credit risk, the risk of borrowers defaulting, into market risk, the risk of these securities losing value. And this was partly driven by regulatory incentives under the old Basel I rules, which made holding these securities look capital efficient.
So the rules actually encouraged it, in a way.
Inadvertently, yes. And this created seriously misaligned incentives. Once banks could sell off the loans, they had less reason to be careful about who they were lending to in the first place. Credit quality plummeted. Plus, the way rating agencies priced the different slices or tranches of these complex CMOs created opportunities for banks to exploit potential mispricings. And crucially, the systemic linkages exploded. Banks became interconnected through exposure to the U.S. housing market in ways no one fully grasped. Diversification turned out to be an illusion because everyone owned correlated stuff.
It all came crashing down together.
Exactly. The lessons were huge. It forced a rethink of organizational structure, how much capital banks need, the danger of short-term bonus cultures driving excessive risk-taking, and the massive over-reliance on complex models that maybe nobody fully understood, or that had hidden flaws like that lack of tail dependence.
A painful lesson. And then there's the classic cautionary tale, Barings Bank in 1995. Nick Leeson.
Barings. A textbook example of operational risk and control failure. Fundamentally, it was a catastrophic failure of internal controls. You had one individual, Nick Leeson, acting as both the head trader making huge bets and supervising the back-office settlement of those trades. This allowed him to hide mountain losses in a secret account, the infamous error account 88888. But there were structural flaws, two confusing dual reporting lines, plus pressure from short-term bonus targets. It all enabled the disaster, the lesson. The absolute non-negotiable need for rigorous audits, crystal clear reporting lines, and a strict separation of duties. No marking your own homework.
Seems obvious in hindsight, but clearly wasn't then. And what about Equitable Life in the UK? That was more of an insurance failure, right?
Yes, Equitable Life is a major case study for insurers and pension funds. Their failure stemmed largely from insufficient capital and mismodeling. They had sold policies with guaranteed annuity rates, GARs, years earlier when interest rates were high. When rates fell dramatically, these guarantees became hugely valuable to policyholders effectively. They were options the company hadn't properly accounted for or hedged. They simply didn't hold enough capital for these massive liabilities. But beyond the technical errors, there were profound cultural issues. The book describes an arrogant superiority, a feeling that Equitable was somehow different and didn't need to learn from industry peers. They were quite isolated. There was also a dangerous concentration of power. The CEO was also the legally required appointed actuary responsible for assessing liabilities. This lack of independent challenge blinded them to the growing risks. Key lessons: the vital importance of independent oversight, having diverse expertise on boards and in management, and fostering a culture that's open to challenge, external scrutiny, and learning from others.
That cultural aspect sounds crucial. It wasn't just the math, it was the mindset. And what's truly fascinating here, you mentioned the source draws an analogy outside of finance entirely to the Space Shuttle Challenger disaster. How does that connect?
It's a surprisingly powerful analogy for risk management failures. With Challenger, a key issue was a flawed definition of what constituted a failure. Engineers knew the O-rings in the rocket boosters were sometimes leaking hot gas, especially in cold weather. But if a leak didn't actually cause an accident on a previous flight, it wasn't officially logged as a flight failure. This led to what Diane Vaughan famously called the normalization of deviance. The known flaw gradually became accepted as normal, acceptable risk.
Wow. They got used to the warning signs.
Exactly. And crucially, on the day of the launch, which was exceptionally cold, engineers warned vehemently against launching. But management, under intense pressure to meet launch schedules, overruled those warnings. The analogy to finance is stark, isn't it? How often might people on the ground, the traders, the analysts, the engineers of the financial system, see warning signs in their models or markets? But managers, driven by bonuses, quarterly targets, or just institutional momentum, might ignore or downplay those warnings because they conflict with desired outcomes. Challenger tragically shows how human factors, incentive structures, and a sheer unwillingness to heed warnings can completely override technical expertise and lead to disaster.
That really hits home. These examples from global finance to space travel just hammer home that risk management isn't merely about sophisticated models and data. It's so deeply influenced by human behavior, the culture within an organization, the quality of governance, and whether people are willing to listen to those uncomfortable warnings that often only in hindsight seem blindingly obvious. The best model in the world can't fix flawed human judgment or bad incentives.
Absolutely spot on.
Well, we've covered a huge amount of ground in this deep dive, from the basic definitions of risk all the way to grand strategies, complex models, and these really sobering lessons from history. It feels like a much more complex and frankly much more human field than just numbers on a spreadsheet might suggest.
Indeed, I think what emerges clearly is that enterprise risk management is this constantly evolving, multifaceted discipline. Yes, it involves creating a holistic, ongoing process. Yes, it involves many stakeholders and increasingly sophisticated analytical tools. But at the end of the day, human judgment, a healthy, questioning organizational culture, clear and effective governance, and truly independent oversight, those remain absolutely paramount. Like you said, the best models are useless if the human system around them is flawed, ignores warnings, or is driven by the wrong incentives.
So here's a final thought for you, our listener. The next time you hear about a company's risk strategy or you read about the next financial crisis, try to look beyond just the market movements or the headline numbers. Consider the human decisions, the invisible incentives, maybe the ignored warnings that might have shaped that outcome. What stands out to you now as perhaps the most crucial element in trying to prevent the next major financial misstep? Something to think about. Thank you for joining us on this deep dive.